Hey everybody, welcome to today's video, and today we're going to be talking about Tritium charging, specifically whether or not the stock is a good value right now that it's come down a lot since where it was in the beginning of the year. Coming up on the market close today, Tritium is trading at $1.18 per share at a $181 million valuation, and this is much lower than where it was earlier in the year. But is this necessarily a good company to invest in? Tritium has a fairly solid business model, in my opinion, for an EV charging company. They're very similar to ChargePoint, where they sell the charging equipment to customers rather than owning it themselves. And this gives Tritium a relatively capital-light business model compared to some other EV charging companies, since they don't own all of their stations and they don't need to make all of that investment. However, we are in a recession right now, so a lot of companies are struggling to raise funds, especially a lot of these EV charging companies who are both newer to the market, and a lot of them are very capital intensive, although as I just went over, Tritium isn't one of those capital intensive charging networks. But that doesn't mean that Tritium is a very safe company to be investing in. This is actually pretty risky. And if you take a look here, you can see that their cash and cash equivalents as of June 30th this year was at $70.7 million. Scrolling down to Tritium's cash flow statement, we can see that the net cash used in operating activities was $86.8 million, and the net cash used in investing activities was $7 million. Tritium was provided $159 million from financing activities, but this is mostly related to the SPAC merger that went through at the very beginning of this year when Tritium went public. But this cash is not coming in from Tritium's operating activities, it's coming in from investors, and since we're in a recession, there are simply less investors that Tritium can tap into in order to raise more funding. If Tritium wanted to raise any significant amount of money through share dilution, their stock would end up taking a really big hit, since Tritium is only valued at $181 million now. Now, the alternative to share dilution would be to take on new debt, which Tritium actually has gone ahead and done fairly recently back in September this year. But interest rates are pretty high right now, so this will probably end up costing Tritium quite a lot down the road. And as interest rates continue to climb, Tritium probably doesn't really want to be taking on too much more debt at this point. So essentially what I'm getting at here is that there's probably not going to be too much more cash coming in from financing activities. And that leaves Tritium with an $86.8 million decrease in cash from their operating activities and a $7 million decrease in cash from investing activities. And remember, Tritium only had $70 million of cash as of June 30th this year, so all of that spending on the cash flow statement, the $86 million here and the $7 million from the investing activities, is eating away at that cash balance very quickly. So Tritium is probably going to need to do another capital raise relatively soon, but in a recession, getting more funding is not something that's very easy to do, and that's why I think Tritium is a pretty risky company to own. I fear that in a relatively short amount of time, Tritium is going to end up in a very similar place to where Volta is today. Be sure to check out my video on Volta's Q3 earnings call, because I think that's a good demonstration of where Tritium may be headed in the future. I hope this video was helpful, and I'll see all of you in the next video.